Welcome to Morningstar. I'm Holly Black. With me is Ben Peters. He's manager of the Evenlode Global Income Fund. Hello.
Hi, Holly.
So what is it like to be an income investor at the moment? Obviously, your bread and butter is dividends, and it looks like they're kind of being cut across the board at the moment.
Yeah, well, it's a very interesting time to be an income investor, and obviously that's what we're here to talk about. I think the first thing to say is that there are a lot of people who are helping us be able to do our job, particularly the frontline healthcare workers and supply chain staff who are enabling us to sit here and talk about important matters like people's savings. So we give thanks to them. But it is a very interesting and I'd say challenging time to be an income investor. I think there are areas of the market where you can find more solid and stable incomes. And if you look at it by sector, then you can see that whether it's in consumer goods, so companies like Nestle and Procter & Gamble, whether it's in healthcare, companies like Sanofi and Roche, or in IT services, sort of Oracle, eBay, helping people to continue to sell things through the crisis. So there are areas, companies that are operating sort of more business as usual, I suppose, although there is no such thing as usual in this environment. But I think that where incomes are concerned, there is risk to dividend streams in the near term, sort of more or less across the market, and that might be because companies are looking to be prudent, where they're seeing potential disruption to cash flow in the short term, and just to make sure they get through the crisis in good shape, or because they want to be treating all stakeholders equitably. Shareholders are one stakeholder, of course. But it might be suppliers, their customers. So eBay is a great example where they're waiving fees for customers to enable them to continue trading on their platform, or whether it's other stakeholders like employees and making sure that employees are treated well through the crisis as well. So you could see risk to dividends anywhere, but there are some businesses that are operating more business as usual.
So as an equity income fund, you have a target for how much yield you're required to produce to earn that title. And last week we saw the Trade Association, the Investment Association, relax that. Is that a helpful bit of breathing space for an income investor? Because there was a concern that you might otherwise have had to ditch funds ditch investments that had cut their dividends or sort of grasp for riskier ones, perhaps.
Yeah, I think it's a very sensible move. I think that comparing yields between a market and a fund is very challenging at the current time when, as you say, dividends are being cut sort of left, right and centre. So I think it does give appropriate breathing space. And I think the knock-on effect of that is that it gives breathing space for companies, the companies themselves to, if they need to, sort of cut or pass or postpone a dividend, which may well be in the long-term interests of the shareholders. Of course, nobody wants to see their income stream reducing. That's a sort of obvious statement. But what's as important, really, if we're long-term investors, is that the total returns that we achieve, so the capital values that plus the income, are good through time. And that will only happen if companies make it through the crisis, and good companies should make it through in an even stronger position, arguably. So that's very important. And I think that the Investment Association's decision to relax those rules in the near term, I think, makes sense.
So you do have a global remit with this fund. So whether it's sector or country, are you finding areas that do appear to be safer in dividend terms within all of this?
Yeah, as I say, there are those businesses. I think that the IT sector has been held up as the sort of archetype for this, with Zoom doing very well, but they don't pay a dividend. So there are some more traditional sort of more income type stocks that are seeing more solid fundamental performance, and of course it's free cash flow ultimately that pays dividends. So that's where we see less risk, but all companies are facing challenges, whether it's in their supply chain or to demand. So you are seeing some more challenges, particularly where you've seen the demand side of the equation changed more rapidly. So companies like AB InBev, the world's largest brewer, about half of its sales are in the on-trade, so in pubs and bars and restaurants and things, and that's obviously fundamentally affected by the current situation. So you can see risk no matter what the sector, depending on quite what the company is that you're talking about.
And finally, Ben, what kind of conversations are you having with company management at the moment? Do they seem fairly confident of their ability to weather this crisis?
Yeah, I think the company management teams have had to act quickly. Clearly, this is a situation which nobody wanted and evolved very fast. So I think we've been very impressed at how company management teams have approached their businesses, about how they're approaching all the stakeholders in the business, not being sort of myopically focused on shareholders or any other stakeholder. That's been very impressive as well. And there are companies that are taking actions which are going to make themselves stronger. Hopefully, they'll have a stronger reputation, stronger competitive position in the future. And I think that it's very important for companies to take the actions that they think are appropriate in the current times. That's really the message we're giving to management teams.
Ben, thank you so much for your time. For Morningstar, I'm Holly Black.